I would rather invest with somebody that had a negative experience, maybe had a project that lost some capital or something, and they're transparent about it and explain to you why it happened and what happened. And if you find out that most of that was out of their control or, something like that, that could be a positive, even though it's a negative on their track record. So they're willing to bring those things out and be transparent about it. That's a huge gold star.
What is Agent Ignite? Get educated on current and forecasted market trends and valuable insight on real estate related topics from accredited experts, giving you a competitive edge in the industry. Sign up for the next Agent Ignite session at theruthteam.com/events.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Mark Cira. Mark is a co-founder of Cira Capital Group, a firm focused on creating diverse private real estate investments. He's a CFO of a consulting firm and a registered CPA. He understands the difficulties that busy professionals face when seeking quality real estate operators and sponsors. For more than 10 years, Mark has focused on finding, vetting, and developing relationships within the real estate industry. With his foundation, Mark co-founded Cira Capital Group to help other busy professionals like himself invest in private real estate. Mark and I talk today about diversifying a little bit, but really we go into vetting operators and why that's so important and some steps that he takes specifically that's been so helpful, as a passive investor, but now helping other passive investors make those decisions and think through operators that are quality and some hard stops that he has about experience or track record or transparency that you're going to hear about that maybe you have not heard before. That you need to know. If you're an operator, you need to hear these things. If you're a passive investor, you definitely need to know these things so you can make the wisest and best decision when investing your hard-earned capital. Mark, welcome to the show. It's interesting that you and I have met numerous times and at different conferences, and I'm looking forward to hearing more about your path to success in the syndication business, right? And how that's worked out for you, what that looks like, and even now how you're helping others achieve success through investing, in real estate and through commercial real estate. And so, give the listeners a little more about yourself, and let's dive into that exact thing.
Hey, thanks, Whitney. I'm really excited to be here. Let me give you a little bit of background about, like you said, where I come from, how I got involved in real estate, all of that sort of thing. So just to take it all the way back to the beginning, I graduated Iowa State University in 2002 with an accounting degree and came out, got my CPA, and joined the ranks of management consulting at Navigant Consulting, Ernst & Young, a couple other smaller shops, and advanced my career. Eventually, I ended up working for one of my clients around 2010 and becoming their CFO in about 2015. And that's where I am today. That firm continues to grow. And so I'm quite busy in a day job as a professional, as a CFO. But about halfway through my career, I got interested in real estate through my wife, actually, who's a general contractor here in Chicago. And up until then, I didn't really realize that normal people could invest in real estate alongside rich people.
Normal people, that's funny.
Yeah, I just always thought it was for, a rich people's game. And she really opened my eyes when we bought a piece of land that we were going to build our own house on. But for whatever reason, we decided that it wasn't quite the right fit for us. So we divided the lot, built 2 spec homes, sold them, and the light bulb came on for me that this is, something that we could do. So we did that and continue to do some of that on the side with her business in developing single family homes, some condos, that sort of thing around the Chicago market. But as my career got busier, I realized there was other opportunities in real estate around syndications and passively investing. And that's really what caught my attention. And around 2016, that's kind of where you and I met at some of the conferences. I started vetting operators. And ever since then, I've been looking deep into who are great partners, what's their track record, and understanding how to become really a passive professional, replacing my income from my day job. So hopefully someday I can be like some of the other passive investors out there, just living off of that cash flow and income, and have a not have to worry about that day job income, and have those options.
Yeah, it's interesting to hear your background. I mean, CPA, your CFO. Your knowledge behind numbers, right? And finances, and then all of a sudden you see this opportunity in real estate, and it's like, okay, light bulb moment, right? It's like many of us go through that. It's like finally, okay, there is a I can see a real path to building wealth doing this thing over here in real estate, right? But go ahead.
Right. Yeah. And then, so today, as we grew in our businesses, we realized that there was an opportunity to really help other people like myself find these good operators and really employ maybe a fund of funds model to help them invest in some of the bigger institutional type players and really get a foundational investment in real estate that can help diversify your portfolio. So that's what we do today.
Incredible. And I want to dive into some of those key things you just said too, like identifying the correct sponsors or quality sponsors, right? How you're doing that. I know many of the passive investors listening, they want to know that as well, right? How do we do that well? Because it's time consuming initially, right? It could be, and you should spend some time on it. It's so important, no doubt about it, building that relationship. And I want to get into how you do that. But then also you mentioned like the fund to fund model. And that's the thing we're hearing a lot more about recently. And I want to hear more about how you're doing that as well. But identifying quality sponsor, walk us through that a little bit. Even for the active sponsors that are listening, they still want to know how they're going to be vetted, right? Or interviewed, and how passive investors are determining who they want to invest with. I know we do, and we want to provide the best care or quality, investments and opportunities for our investors. So how do you do that? Mark, how do you identify those quality sponsors from all the operators out there?
Yeah, well, from a high level, I kind of employ the 80-20 rule generally, just looking at 80% who the sponsor is and what's their track record, how long they've been in the business, what are their ups and downs, how do they communicate to their investors, what are the challenges they faced and how they have addressed them. So all of those things come through developing those relationships, seeking out other investors and understanding their experience with the sponsors, and then asking some of those questions in interviews with sponsors and their partners. I tend to focus on longer track record operators that have been in the business for 10 years or more because, we've been in a very favorable market for quite some time now. And I like to see what they did over the last downturn. That doesn't mean that new operators aren't well suited to deal with the same issues that we could see in the future. But it's one of those criteria that I focus on quite a bit, at least in some of the long tenured operators.
Yeah. And you do have to kind of set your rules for yourself, right? These are the things I'm looking for. I mean, we do that in so many areas of our life, and you should do it for focusing on a sponsor as well. Well, here's some kind of non-negotiables for you, and it's going to be different for different people, right? What are some other non-negotiables for you, Mark? You want 10 plus years of experience. That right away is going to eliminate lots of sponsors. It's going to help narrow it down. Right away, you're going to get people with a lot of experience, hopefully exited many projects, right? As well, been through a downturn or so. And that gives you a lot of time to ask about, right? Like, how did you do during this downturn? What happened? And I loved how you said too, the challenges, what challenges have they had? And then how did they respond, right? It's not a matter of if they've had challenges, right? I mean, it's like,
absolutely.
If you're in real estate, you're going to have challenges, or growing almost any business, right?
That's right.
You ask a sponsor, what's some challenges you've had? And they say, oh, I've never had any challenges. Well, guess what?
Right.
That's probably a red flag, right? What are some other non-negotiables for you, Mark?
So transparency is a big thing to me, understanding not only how they're going to communicate what the investment opportunity is, the financials underpinning it, what their assumptions are, but also going back to that track record. Tell me about that bad project that you had, how you communicated, what you communicated to your investors, and how it was resolved. Even if it's negative, I would rather invest with somebody that had a negative experience, maybe had a project that lost some capital or something, and they're transparent about it and explain to you why it happened and what happened. And if you find out that most of that was out of their control or, something like that, that could be a positive, even though it's a negative on their track record. So they're willing to bring those things out and be transparent about it. That's a huge gold star.
Yeah. To speak to any other ways that you like to see an operator be transparent. You mentioned about like underwriting and assumptions and some of those things. What shows you that, hey, this is probably going to be an operator that's transparent, or maybe, I don't know, what do they present to you early on that says, hey, I really like how they're communicating these things? Anything that stands out to you? I'd love to hear that myself. I know other operators do too.
Yeah, it usually comes very early on when you reach out to a sponsor and say, hey, can you provide me with your track record? And you go through that list of the 15 projects that they finished, and all of them have 20 plus IRRs. And you go, okay, let me ask you a question about, do you have any projects that were negative? Or if they just simply do not, offer any challenges when you initially ask, hey, tell me about your challenging projects. they have nothing, like you said earlier, typically that's not a great sign around the transparency.
Sure. No, and is there any way that you'd like to see that presented? Those previous deals, or maybe somebody that stands out to you. I mean, or the way that it was presented to you from a quality operator that you've met.
Yeah, usually you'll see the project, what the projection was, what the result was, and then some sort of note on the side that's a highlighted project. We'd like to talk to you about it. I've seen that on some really quality operators, identifying the negative project and why, and talking about it first.
Yeah, that's great information. And even I would encourage too, even new operators. We've started doing this, and we didn't do it initially. It would have been much easier if we did. But like tracking that, right? Like, keep a list of your deals, what your projections were. You start exiting projects. Well, what were the actual returns that investors received? And, and then it helps you to create things like Mark's talking about, so you can present it in a way to investors that's easy for them to see it all in one place, right? And as you grow, it gets harder to remember, wait a minute, or maybe even find some of those documents from 5 years ago, that gets more and more difficult. So it's better to track that up front. What anything else, Mark, or anything else about that, about identifying that quality sponsor?
Sure. Yeah. Going back to that 80-20 rule, 80% around the sponsor and their quality and how they present themselves, all those sort of things. 20% around the deal or the fund, economics, that sort of thing. Looking at the financial projections and their pro formas, but understanding that those are generally always going to be wrong, right? No one performs exactly to plan. You almost always see variability on the exit from what the projection was. So understanding that those are just projections and focusing more on what their assumptions are and making sure that those operators have generally, in line with economics, appropriate underwriting assumptions. And a lot of that can be vetted up front. Even before a deal is presented to you, you can get familiar with what an operator is expecting in different markets and how they underwrite each project in those markets generally.
Yeah, I love that. How long would you say it normally would take to vet a sponsor? Or how much time should a passive investor commit to, with this sponsor or potential sponsor before actually making that commitment?
Well, that's a tough question, and it may become, a little bit of a gut check on when you get comfortable. Some people, I think, you may get pretty comfortable very quickly if they're very transparent. Here's all the information. Here's 5 investors you can go talk to, all teed up, assuming those investors aren't just being teed up because they're the biggest cheerleaders or something. Those types of things could get you to the finish line quickly. But I would say I generally spend, a month or two, a couple months, just looking back at other projects, maybe schedule a trip to go visit one of their current portfolio assets and walk around and, maybe have a trip with the sponsor and then go look at the deal that they're pitching for their next raise and walk the property with them, see how they see the property through their eyes.
Yeah, that's incredible. And we offer that to all of our investors, but very few are going to take the time typically to take us up on that. Unfortunately, I think it's great because walking the sidewalk of the property you're going to invest in, or even a previous deal that the operator has done, just gives you so much face time, right? With that operator, and I know me personally, it some of that time allows you just to fill them out more as a person, as much as their operating experience as well.
That's right. One other point on that, if you do go to a property that they've held for a couple of years, you often can see some of the work that's in progress and see, what have they done compared to what they plan to do and how, what's the quality, all those sorts of things on site as they're managing the property.
No doubt about it. And I wanted to hit though as well, you mentioned that you are, you're working on like a fund to fund model. And would you explain a little bit about what that means, to you or what you're working on? And let's dive into that a little bit also for those past investors as they're looking at, investing. Why should they be aware of what that means?
So fund of funds really is, in a simplistic way, exactly what it sounds like. So you're raising a fund of capital from investors in order to place it with other sponsors. And, there's a lot of objections to that. Like, why would you place your money in a fund that's going to have some fund drag? Of course, you have organization expenses and operating expenses, et cetera. But there are benefits if you do it right. And that is investing with sponsors who provide either tiered investment structure. So a larger investment garners a larger split of, or a larger preferred return or a better split of the profits. And so therefore you can offset some of those fund fees through those larger investments. Or maybe there's an operator who has a minimum in the, 7 digits, $1 million or $5 million. And most accredited investors, they're investing 25 or 50, maybe 100,000. They would not be able to get into those funds, or it just wouldn't be prudent to invest $1 million, of your portfolio in one operator or one asset, that sort of thing. So you get that diversification benefit in something like I work on, which is a couple of operators with diverse funds themselves. And so that is a natural portfolio diversifier if you're just a 401k type investor and you're looking for some real estate. So that's really where I focus and why I believe the fund of funds is a beneficial model for a lot of investors.
Yeah, no doubt about it. Speak to even vetting, somebody like yourself, right? That's going to operate a fund that passive investor is going to invest in. Yeah.
So how would you vet myself if I were right. Someone looking at me? Yeah. I mean, I think, it does go a lot of the same way. Like, what's the track record? Who are the sponsors that you're working with? You want to be able to look through that transparency. That's what we do. We provide complete transparency to who we're investing in, because that's what you want to know as as an investor. Ultimately, where's my money going? So, having that, I think, is the biggest hurdle. And then looking at some of the back end operations. Where are the funds going? How are you managing them? Who are your legal team and your accounting team, and what's their experience? All of that sort of thing. So it comes probably more of that 80 than the 20, because the financial underwriting is more related to the investment that the fund is making, and more about the quality of who your sponsor is and whether they're going to be there throughout the life of the fund.
Yeah, no, it's incredible. And I think, at that point too, it's trusting your ability to do what we talked about earlier, right? And vet those sponsors. But it's going to take, less time for that passive investor, hopefully, because they're trusting you to do that, right?
That's
and,
right.
you to do that due diligence. But I love the diversification of that as well. And I know, doing a fund personally as well, that it's like investors are not only getting diversification through markets, but just cash flow diversification that I love as well, right? I'm split up then across numerous projects instead of just one. And so there's, pros and cons to both. I hear investors gripe and love both, both models.
Yeah, it's not for everyone, right? It's not
right.
for everyone. And I think that's important to understand, right? Some people are more risk averse. Some people are more risk taking. And I think there's a place in your portfolio for both of those pieces of the pie. And having a foundational piece like this, I think, is important. Just like the institutions that you see invest out there, they're not all in emerging markets or in Apple stock. They have diverse portfolios, and some of that's in real estate, some of it's in private equity, some of it's in stocks and bonds, and all kinds of things. And I think that's important for a healthy portfolio.
Speak to the type of fund that you've chosen to operate, or what an investor should even know about the type of fund that you're operating.
So I'm operating a fund that's diverse in both, like you said, operators, markets, and sectors of the real estate economy. So we're touching on multifamily, self-storage, manufactured housing, mainly in this fund. So you get a little piece of a lot of assets, more than 40 assets eventually will be in the fund. So, we're talking about pretty broad diversification and, multiple operators, like I said. So.
Yeah. So is this an evergreen fund? Is it open forever? Is it, what's kind of the time horizon, for your fund?
So usually your fund of funds will match the time horizon of the underlying investments. And these are 7 to 10 year investments. So it is not evergreen. It will close as the underlying investments sell their assets and close up their funds.
Okay. Anything else about maybe the fund portion of this specifically, or fund to fund, that a passive investor needs to know about that maybe they just wouldn't be educated about, that you can think of?
That they need to be aware of with the fund of funds.
Right. Yeah. Just investing in a fund, like that. Anything else that maybe a passive investor wouldn't be as savvy to, but maybe, it's a good opportunity for some. Well, anything else that maybe, that people often questions that investors may have of you often?
Yeah, I mean, I think there's usually questions around what are the fees and what are what's the fund drag and how do you offset that, through returns. And I think we touched on that earlier, with tiered investment structures and access to, institutional quality operators that you may not have in your personal, network or reach. Let's see, other things to be aware of. I think the general concept is that it's very familiar to most people in syndication world. So if you're familiar with how a property is syndicated, a fund of funds is very similar. It does have to be compliant with a few extra rules around the Investment Advisor Act and the 1940s or 30s acts of SEC registration. But other than that, it's very similar to what you're already used to.
Okay. What about, Mark, do you have any predictions for the just real estate market over the next 6 to 12 months? And that's going to come into play with probably the types of markets you're looking, to invest your fund in, or operators or asset classes, anything around that?
Well, I think, we're seeing inflation and interest rates. We're in an uncertain time right now. I think if you asked me this at the end of 2021, I would have said the future for 2022 looks like, the Fed getting after inflation with rate increases that are going to go through the end of 2022. And I think that's probably still the case. They may be pretty aggressive in the first half of the year. And all of that's going to be impactful for pricing, I think, of assets and what they're going to trade at, their cap rates. But there's a lot of capital out there still chasing deals. So I don't see a major impact right off. The question really becomes what happens after 2022 with this uncertainty around conflict in Europe and whether that escalates or de-escalates and how that affects our economy towards the end of the year is really going to drive, I think, real estate in the next year is really the big question mark. In my opinion, there's some clouds around that.
when we talk about, I ask a lot of operators, how do you prepare for a downturn? And maybe you can speak to, when you're looking at operators and even vetting them, kind of like we were talking about earlier, what do you like to see there? How, when you think about, hey, are they prepared for hard times, right? Potential hard times or maybe unforeseen things, right? What do you like to see?
Well, this is one of the reasons I go with operators that have had a long track record, because I've seen these downturns. They usually have very long track records with their lending partners. They have access to capital that most younger operators may not have access. So if they get into a situation where they need to pull on a short-term, loan or line of credit or something to, withstand a short run in revenue, they can do that. Where I think a lot of younger operators may not have that ability. So having that experience and how to weather those types of situations is important. And then again, that's why I think the diversification is so important, because, you just never know on a single property. And the worst thing you can have is a property or a piece of your portfolio go to zero and have a goose egg, because those take forever to climb out of and recapture your capital. In my opinion, you got to avoid that as much as possible.
Yeah, no, great advice. What's your best source for meeting new investors right now?
It's a little bit tough, right? With the COVID stuff. At least we're getting out of that now and conferences are happening again. I think getting out there, what I've learned over the last probably 2-3 years is getting out there on podcasts like this, Whitney, is very important to meeting investors, going to meetups. So I'm happy that we can get back out there into conferences and meetups. And I'm really excited to be getting on more podcasts like this.
Awesome. Yeah, it's definitely very valuable to get your story out, right? So people can meet you. What about some habits that you have, Mark, that you're disciplined about that have helped you achieve success?
Yeah, 2 things over the last year that have really helped is time blocking. So finding specific periods, especially since I have, a busy day job, finding time to do the real estate as well. I have to block off specific periods of time to talk to investors, to podcasts like this, to do underwriting and all of those sorts of things that go along with running a fund. Same thing, finding help. So employing who, not how, and figuring out who can help you around. Yeah, you got that one there.
Yeah,
around doing some of the blogs and those sorts of things, helping you proofread your articles and things like that. So there's all kinds of things that you can outsource that you don't realize until you start to look at your time blocks and figure out what you're doing. with your time.
What about how do you like to give back?
So I'm busy. So usually what I do is provide support to various groups. And two groups that I support a lot is Surge for Water, which provides sanitation and clean water to developing countries around the world. A very good friend of mine, Shilpa Alva, is the founder of this organization. And so I help her. The other one that I'm a big fan of is Thresholds here in Chicago, which helps homeless and, mentally challenged and, sometimes addicted people around the city, which we see is a huge problem and a growing problem in many large cities around the country. So I really suggest people find ways to help the mentally ill and homeless find shelter and recovery.
No, that's awesome. Mark, I appreciate you giving back in that way and even giving to us today your time. I understand it's the busyness of running a business and you're also working full time. It's a lot, right? It's a lot to make all of that happen. But I just appreciate your background as a CFO as well. And how you're even implementing that. I'm sure you're using those skill sets in a big way to vet sponsors, right? And look at underwriting and in ways that a lot of investors just don't have the skill set, right? Or the experience behind numbers alone, much less the other things behind, vetting a sponsor. So, you're making a quality decision, quality investment, right? The 80-20 rule, the who, the track record, the communication, the challenges that they faced and how have they been addressed? I thought that was crucial. And even, seeking other investors out and asking about their experience and thinking through the transparency. I love that piece. You talk about, it's a must, right? It's a must. We work hard at that. It's like, are we giving investors everything we can, but not only just like throwing it on them, but is it in a way that they can understand it, right? Does it make sense? But thank you again for your time, Mark. And how can the listeners get in touch with you and learn more about you?
Sure. You can head out to our website at ciracapitalgroup.com. That's CIRA capitalgroup.com. And you can sign up, send me an email through the contact page at Cira Capital Group.
Thank you for being a loyal listener of the show. Please subscribe and share it with your friends. We want to help you become the passive investor you've always wanted to become, but also the operator you've always wanted to become. We want to be the number one resource for your real estate investing journey. But go to lifebridgecapital.com where you can start investing in real estate today.